Hello and welcome back to Global Value. In today's video, we'll be taking a look at OpenText Corporation, ticker symbol OTEX. We'll be performing an in-depth stock analysis of OpenText, taking a look at their financials to come to a beginning holistic understanding of the business. So currently, OpenText is trading for just under $40 per share. So far this year, they're down about 16.5%. Going back 1 year, they're down 15%. But zooming out over the past 10 years, they're up 12.5% compounded annually. Going all the way back to 2005, that level of return holds steady. They're up about 12.5% compounded annually all the way since 2005. So their stock price has performed steadily. Scrolling down, we can see that they're trading for just about $5 over their 52-week low, which is down a bit from their 52-week high. OpenText has a $10.6 billion market cap. To get some context about what the business does, OpenText Corp grew out of a technology product involving the Oxford English Dictionary at Canada's University of Waterloo in the mid-1980s. Its software allows clients to archive, aggregate, retrieve, and search unstructured information such as documents, email, and presentations. OpenText Corporation designs, develops, markets, and sells information management softwares and solutions. The company serves organizations, enterprise and mid-market companies, public sector agencies, small and medium-sized businesses, and direct consumers globally. It has strategic cyber security and content management services, as well as data analytics partnerships with its blue-chip enterprise and consulting customers. The company was incorporated in 1991 and is headquartered in Waterloo, Canada. So with that background about the business, let's get right into our fundamental analysis. We'll be performing an 8-pillar analysis as popularized by Everything Money to look at 8 different financial metrics concerning the business to give us a beginning holistic understanding solely based off OpenText financials. So let's get right into it. Starting off with pillar number 1, we want OpenText average 5-year PE to be below 22.5. So currently it's trading at just over 22.5. And over the last 5 years, OpenText has traded at an average of a 47 times earnings multiple. So pillar number 1 is an X to start. Pillar number 2, we want their average 5-year return on capital to be above 9%. So we can see that it's held pretty steady in this about 7 to 9% range. However, averaged out, it's still only at about 7.5%. So pillar number 2 is also going to be an X. They only earn about average returns on capital. Pillar number 3, we're looking for 5-year revenue growth. So this is going to be our first check. They've grown revenues from nearly $2.3 billion in 2017 to just under $3.4 billion in 2021. So our first check for 5-year revenue growth on pillar number 3. Scrolling down on their income statement, pillar number 4, we're looking for 5-year net income growth. This one's going to be an X due to what looks like an outstanding year in 2017. After looking at their income statement, it looks like they had a major tax credit that allowed for this huge spike in net income in 2017. So that was an atypical year, meaning that pillar number 4 is going to be an X. Pillar number 5, we're looking for decreasing shares outstanding. So in 2017, OpenText had about 256 million shares outstanding, and that grew to nearly 274 million shares outstanding in 2021. So pillar number 5 is going to be an X. When you purchase a share, what you're really buying is an underlying ownership percentage in that business. When a business issues new shares, what they do is they dilute existing shareholders, which ultimately means that you're entitled to a smaller ownership percentage of the business, and you're entitled to fewer of the company's profits over time. We don't like to see a business diluting existing shareholders as it ultimately robs them of their percentage of the business. So pillar number 5, we see slight dilution, and that's going to be an X. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. Free cash flow is this column in green. So we see that they've grown free cash flows from nearly $361 million in 2017 to nearly $812 million in 2021. So that's a check on pillar number 6. Looking at this free cash flow profile, it looks like they have to spend very little on capital expenditures, and they're still able to generate a lot of cash from operations. So this is a good sign here, and this is something that's probably more typical for a free cash flow profile coming out of a software type business. Averaged out over these 5 years, they generate nearly $700 million of free cash flow a year. So we'll use that in pillars 7 and 8. So pillar number 7, we want their net debt to be below their average 5-year free cash flow multiplied by 5. Net debt is long and short-term liabilities minus cash and short-term cash equivalents. So as of the end of fiscal 2021, they had $2.3 billion in net debt, which means that they had $2.3 billion of debt left over after subtracting their cash and short-term equivalents. Multiplying their average 5-year free cash flow of nearly $700 million a year times 5 brings us to $3.5 billion. So pillar number 7 is going to be a check. If their next 5 years of free cash flow are anything like their average years, they'll have more than enough money to pay off all their liabilities. So this means that they're in a strong financial position. Finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20. So currently they have a market cap of nearly $10.6 billion. Multiplying their $700 million of free cash flow each year times 20 brings us to $14 billion. So that is going to be a check on pillar number 8. Based on their free cash flow profile, it looks like OpenText is slightly undervalued. Once you add back in their total liabilities to get this total enterprise value, that comes out to nearly $13.5 billion. So it looks like that's more approximate based off their free cash flow profile. So it looks like the business, again, is either fairly or just very slightly undervalued based on this one metric alone. So in summary, OpenText checks the box on 4 out of 8 pillars. They're trading for a little bit of an expensive PE multiple. They generate just about average returns on capital. However, they have grown revenues. They were close to growing net incomes, but they had an atypical 2017. One bad sign is they're slightly diluting shareholders. However, they've grown free cash flow. Their free cash flow profile looks like it's in pretty healthy shape to pay off their liabilities. And based on their free cash flow yield, the business looks slightly undervalued. So this is just a beginning understanding of the financials of the business. If you're interested in learning more, I highly recommend checking out their annual letters and looking at other corporate filings to get a more in-depth and nuanced perspective of OpenText. Well, guys, that's it for today's fundamental stock analysis of OpenText Corporation, ticker symbol OTEX. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what company you want me to take a look at next. Thank you for learning about OpenText with me, and have a great day.